All right. So I want to talk about the conceptual sort of parts of how, not just conceptual, but also like how does a choice of cost flow method affect my financial reporting essentially. And it can affect it in a few ways. So the advantages and disadvantages, mostly going to talk about Lifo and FIFO because they are the extremes, right? We have, well, first we're selling all the stuff we bought a long time ago. Always our beginning inventory sold through first, and then we're going to sell our more recent things after that. And then Lifo is talking about, I don't even want to think about beginning inventory. I only want to get the stuff that I just most recently purchased. So for the advantage of FIFO, maybe it's a small advantage, but it is like a truth that it's less of an assumption. It does correspond to the physical flow of goods in most businesses. We know that the cost flow method doesn't have to, but it does more closely match reality. Inventory on the balance sheet is closest to current cost. So think about that in terms of when I was working my FIFO, and remember, it's the same under periodic or perpetual, but the stuff I was assigning to cost of goods sold, right, was at 1.1, 1.8, 125. The stuff that I was putting on my ending inventory was coming from the purchase dates of January 25th and January 29th. And, current costs are going to the balance sheet. Well, these costs are more current. Ending inventory, the balance of my, what's left of my ending inventory, that's my inventory account on the balance sheet. And of course, cost of goods sold is going to the income statement. So in terms of the dollar values that I'm reporting on the balance sheet versus the income statement, if I choose FIFO, then my ending inventory is at more recent prices. It's a little more relevant, that balance, because it's what I have to pay now to get more inventory. Whereas cost of goods sold is at older prices. So it puts newer prices on the balance sheet and older prices on the income statement. So the inventory on the balance sheet is closer to current cost, and this provides relevance. We're getting our most up-to-date numbers to inventory account. When prices are rising, right? So when prices are rising, times of rising prices, and really, I say rising prices, and they do move hand in hand, but to be very precise, inventory costs is what a better, because price sort of corresponds to like the amount that I'm selling my inventory at, but I'm talking about when it costs me more to manufacture or buy inventory. So in times of those, which generally tends to be the case on a macroeconomic, large scale level, prices just rise over time. Unfortunately, pay doesn't rise quite as quickly as prices do. Cost of goods sold tends to be lower and net income higher. Well, why is that the case? Because if prices are rising over time, then I'm ascribing the older purchases, the beginning inventory, to cost of goods sold. So it's at relatively lower dollar values than the prices that I'm saying, no, that inventory is still on my books, right? So if cost of goods sold goes down, and that will, all things equal, create more net income, right? Cost of goods sold goes down, gross profit rises, net income rises. So that is, a financial reporting advantage of FIFO. The disadvantages, cost of goods sold is not based on those current costs. We just talked about that. Cost of goods sold is based on the old costs, which can produce a sort of error in our matching. Old costs are being matched against current sales prices. So it might be, right, I sell through my beginning inventory. Well, I bought that stuff maybe last year, and now I'm matching it against sales that I'm making in December of the following year. So that could be problematic. In times of rising prices, cost of goods sold is relatively lower, which increases tax expense. And we're going to see that in a moment. That's something that actually drives most companies to choose Lifo. When cost of goods sold is lower, we report more net income. With more profits come more taxes. So we have an increase in taxes. What are the advantages of Lifo? We match current costs with current revenue. The most recent prices are placed in cost of goods sold. So if we look at that Lifo method that I was doing over here, right, what's going to cost of goods sold? It's these guys that I'm putting into cost of goods sold. The stuff I sold at 2 days from the end of the month, 6 days from the end of the month. Well, because I didn't make any purchases, I have some of those, but I don't include my ending inventory. I don't include the stuff that was in my beginning inventory in cost of goods sold. I put it in my ending inventory, so it gets left behind. It's tax advantaged during times of rising prices, right? We have the same issue that happens up here with cost of goods sold, except that how does this occur? Well, if we have more recent prices being put in cost of goods sold and prices are rising over time, right? I'm putting my most expensive stuff, let's say this was like $11, $9, $8. My more expensive items are going into cost of goods sold versus the $8 and the $7 that are ending up in ending inventory. So during rising prices, it will increase cost of goods sold, which reduces pre-tax income, which means we have less tax. So basically, the increased cost of goods sold is a way of taking a tax deduction. There's a smaller chance of write-downs using lower of cost or market. And that's kind of a, yeah, I mean, it's an effect. I don't know if it's necessarily an advantage, but we already have lower prices here because we're ascribing the older prices to ending inventory. So it's less likely we're going to have to make a write-down versus under FIFO, where we put the more expensive currently bought items in my ending inventory. And it reduces something called inventory profits. And inventory profits are the difference between what I would have to replace my inventory at now and the inventory cost that I'm using because of a cost flow assumption method. So for example, in the FIFO, it has a large inventory cost because I'm throwing $7 assumed priced goods in my cost of goods sold, $8 goods, $9 goods, right? I'm throwing these older prices into cost of goods sold. It might now require $12 to buy those units if prices went up. And so I'm generating a sort of false pad of profit by reporting under those alternate methods. Whereas with Lifo, you're using the most recent costs to put into cost of goods sold. So there's less time for there to be a price movement that would generate a difference between what I put into cost of goods sold and those old prices. What are the disadvantages, right? We have relatively lower priced inventory balances. And that just feeds off of the same idea, like 3 and 2 are two sides of the same coin. We have less dollar value reported on the balance sheet, but that actually is advantageous when you think about, well, do I have to perform a write down? It's harder to write down a value that's low than it is a value that's higher. It does reduce net income, and that is that companies are willing because there's less tax, but they will report lower net income. We can what we call liquidate old Lifo layers. That means I might have, for example, with this one inventory log I made, let's just say, and we'll look at it again a little bit more, but let's just say I never sold through the entire inventory. Like in this case, I sold through everything and I had like these, if using Lifo, I had these 200 and I had 350 of these left. Well, let's say that I purchased more in February and I didn't sell through all of my most recent purchases. So that still remained. And then March, I purchased more. I didn't sell through all my purchases. That still remains. That can go on for a long period of time, such that if you're using a Lifo system, this beginning inventory could have been at a price that you purchased years ago. And I'm talking years ago. So you might have old layers that if you don't sell through your entire inventory, purchases plus everything you started with, you're going to have these old Lifo layers sitting around. It's just like that. If you remember my analogy with the dog food bins, it's that stale dog food at the bottom of my bin because I never went through and basically scooped up all that last little layer of dog food. I just kept adding to it over time, adding to it over time, adding to it over time. If we do liquidate Lifo layers, then we're going to have an extreme movement in my advantage of cost, my advantage of Lifo, where I'm reporting high cost of goods sold and lower taxes, is going to go away, because if I then break into those old layers, it's going to be at a very low price that I'm assigning cost of goods sold. So it could potentially reverse the tax advantage and create inventory profits. From very, and I'll just underline, old purchase prices. There's a bigger possibility, a greater possibility for income manipulation. If you're a manager looking to opportunistically report lower cost of goods sold, you could just time purchases so that you sell through old layers. That would be a problem. And it's also problematic for projections. So if, for example, I'm sitting in March and I want to project what my cost of goods sold is going to be for the year, right? It becomes hard, because then I have to predict, well, what are the prices going to be doing from March to December? Are they going to be going up? How much are they going to be going up? You know, it really, especially in a periodic method, your projection is going to be mostly based on purchases you made at the end of the year. So you need to predict how much you're going to be purchasing, what the prices are going to be, all of that, it becomes a lot more inputs. Whereas if you're using FIFO and you're at March, you know already the price points that you're going to be selling through because you have your beginning inventory in January, the purchases you made from January to March. So you have more information that is actually solid, already known versus projections. So there are some disadvantages to LIFO as well. Now, that being said, and this kind of kicks it into a more general lecture. What the, I think the most recent guesstimate sort of average from taking a statistical sample was that like 60% of companies use LIFO. And the reason they do this is taxes. It's a tax abatement scheme. Increased cost of goods sold produces lower gross profit, which if we assume the operating expenses and other income expense items are equal, gives me lower pre-tax income. And if I have lower pre-tax income, then I get lower taxes. And yes, you do also get lower net income. So that's a happy moment. And the net income going down, that's not necessarily a happy moment, right? So why is it that companies are willing to kind of take a hit on net income to get lower taxes? And the rationale behind it really is that I have to pay my taxes in cash, right? They cost money. And so I'm saving cash today by having lower taxes. Net income, while it is a great indicator of performance, while it is, to me, the best reflection of present and future profitability, you can't pay your tax. You can't use net income to pay bills. This is an accrual-based number. Right? We make some accounting decisions that we put in revenues that we haven't collected cash for yet. We put in expenses that we paid the cash for sometimes many years ago. If we bought a piece of equipment, we still have depreciation expense, even though we bought that equipment 10 years ago, we're still using it. So because it's an accrual-based number, not as much incentive if I'm going to get lower taxation, because the lower taxation will save me money, saves cash, which is greater than saving on accrued expenses. Right? The cost of goods sold, it's just an accrual number. I've already bought the inventory. I already paid the amount. Now I'm just choosing when to express in my cost of goods sold that acquisition of inventory. Do I want to put the $7 units in my cost of goods sold or my ending inventory? Well, Lifo puts the $7 units in ending inventory. It puts the higher priced units in cost of goods sold. Is there any difference? Am I saving any money by choosing Lifo versus FIFO? Absolutely not, right? I'm just choosing, I've already spent all of this money. I already purchased all of this stuff. So that's a sunk cost. I'm just choosing when to express the expense of buying the more expensive versus the less expensive stuff. During times of rising prices, Lifo puts the more expensive stuff into cost of goods sold, which triggers less taxable income and saves cash, right? So that's really that at that moment, after the stuff has been bought, you don't have a choice of how much money, cost of goods sold doesn't tell you. You don't save money on dollars on cost of goods sold by choosing the cost flow method. You're just choosing when to recognize the expense. But with the taxes, you can actually still save money. So does that make sense to people? Any questions about that? All right. So the next piece then is we can use different tax reporting methods versus GAAP reporting. So I want to, we're not going to really delve into this too deep, but I do want to open this idea to you, because as you get further into your accounting education, you're going to learn, if you're an accountant, you're going to learn about taxes and how taxes are reported. And then in intermediate 2, you're going to study what we call book tax differences. And that's going to be, it is actually a very complex subject that gives students a lot of pause. You got to think it through a lot. But if you think about the world of tax reporting, the world of tax reporting is controlled by the IRS. The world of GAAP reporting, financial reporting, what we're studying, is controlled by the FASB and to some degree the SEC, right? The standard setter, the regulator / sometimes standard setter is the SEC. And so there's different rules under each one. Under tax reporting, for depreciation, I'll just say that the accelerated methods are preferred. So companies will report accelerated methods of depreciation. They have makers, they could use a declining balance. I mean, the TCJA, the most recent tax act it came into law in 2018, said, hell, you can depreciate the whole thing in the first year by your taxes. That's controlled by the IRS. Now, the preferred method under GAAP is straight line, so preferred. In fact, straight line is used by, I would say, for the estimate, I think the book, or I read somewhere, was 90% of all assets owned by public companies use straight line methods, because it's simple. It just evenly distributes the expense over time. In tax reporting, they want to accelerate the depreciation because they want to deduct the most expense they can this year. And again, that's because they're getting cash from it. They're saving some money on taxes by making that huge deduction, and they're paying fewer taxes this year. I want to save money now as opposed to later, because money has value in time, right? $1 today is worth more than getting $1 tomorrow. Well, not much difference, but $1 today is certainly worth more than $1 a year from now. Okay. So that's depreciation expense. When it comes to inventory, this is going to be the hypothetical. If companies could do whatever they wanted, then the preference would be very easy. Let's report cost of goods sold on my taxes. I save my tax money. I'll report FIFO here to increase net income, because I don't want to report high cost of goods sold, because it doesn't matter really how taxes are calculated is by this tax reporting over here. Cost of goods sold will increase my COGS. that creates a tax deduction. However, there is a very explicit rule that says that can't happen. It's called the Lifo conformity rule. And it says if Lifo used for tax, then must be used for financial reporting. So they're not going to allow the company to get sort of the best of both worlds. The best of both worlds would be we get our tax deductions by reporting high cost of goods sold. We'll use FIFO over here, report low cost of goods sold under on our financial statements. That'll increase my net income. But they established a rule that says that's one place where we tell you you cannot use one method on taxes and a different method for your financial reporting. Depreciation expense, lots of other things we do in accounting. You can choose one method for tax, another method for financial reporting, but this is where they say, nope, these two things have to be equal, right? So this is a big deal because if companies could get away with it, they would all use FIFO. It would be like 80% of companies use FIFO for financial reporting, but it's only 60. And part of that is, part of that is that, you know, while there is, it's better to save money and report lower taxes, yada, yada, we're controlled. We want to do it in our taxes. We have to do it here. So that's why about 60% of companies report LIFO on their financial statements. Now, to make it a little bit more obtuse, remember that I mentioned under the disadvantages of LIFO, there's some other concerns. And a lot of it stems from, like, it's hard to manage inventory under a LIFO system. There's manipulation opportunities for LIFO system reporting. And so what occurs is a lot of companies, and it doesn't reflect the physical flow of goods. So LIFO is difficult for inventory management. Projections, et cetera. So understanding what costs are going to be at the end of the year, how much I'm going to sell at the end of the year. So consequently, companies don't like using LIFO for internal bookkeeping. They do like to use it for the tax advantage. And also, there's a bit of a concern by users that since there is a pretty huge ability for companies, cost of goods sold, which is a the most major expense for a company on its income statement if it sells merchandise and goods, to be reported differently under one flow method versus another. So they want to have comparable statements. One of the things we do then is companies that use LIFO but have a alternate system that they use internally, there is what we call an adjustment to translate, non-LIFO inventory and cost of goods sold to LIFO amounts. So you're going through the period, record everything at the non-LIFO. And it could be average cost, it could be FIFO, but you're not using LIFO during the period. Then you make a adjustment to the LIFO reserve. That adjustment to the LIFO reserve is going to involve either a debit to cost of goods sold and a credit to inventory, or a credit to, I'm sorry, debit to cost of goods sold, a credit to the LIFO reserve, or a debit to the LIFO reserve and a credit to inventory. Sorry, can't get these two accounts straight. Right. LIFO reserve, cost of goods sold. Those are the two accounts. You either debit COGS, credit LIFO reserve, or debit LIFO reserve and credit COGS. Why does this happen? What we're doing is translating my inventory from non-LIFO to LIFO. And then after I've adjusted that, I report LIFO, COGS, and LIFO inventory on the balance sheet. So how this is done is through a contra account, the LIFO reserve account. It is a contra inventory account. And it is going to convert me over from what my inventory balance is to a balance sheet amount at that date. So let me make up some numbers real quick. Let's say that my inventory has a beginning balance of $100 and we got an ending inventory balance of $225. My LIFO reserve, we'll say, started at $10 and ended at $13. So how would this affect what I report on the balance sheet? And that's $100, not 700. So a strange looking one. If this is at 12/31/21, and this is at 12/31/22, same story over here for the beginning and ending balances. Then how does that affect what I'm going to report on my income statement? Remember that if I'm using a LIFO reserve, if this account exists at a company, then this inventory is in non-LIFO. So the presence of the LIFO reserve account indicates the inventory account, the inventory ledger account, is non-LIFO. So the $100, the $225, it's a non-LIFO method. Maybe it's FIFO, maybe it's average cost, but it's not LIFO. This is there precisely to convert these numbers to a LIFO amount. Well, what's going to happen to my inventory amount? Remember, contra accounts or adjunct accounts, their sole purpose is to modify the account that they're attached to when reporting it on a financial statement. So I take an aggregate of these two numbers and report it on the balance sheet. Because it's a contra account, I want to subtract. So on 12/31/21, the inventory balance would be 100 less 10. It would come out to 90. That's what it would be on a LIFO basis. This is the non-LIFO inventory amount. After adjusted for LIFO reserve, now it's 90. After adjusted for LIFO reserve, my balance on 12/31/22 is going to be $212, 225 minus 13. So the entire purpose, remember, of doing this LIFO reserve is because companies, this is that narrative, right? I mean, you could just memorize debit cost of goods sold, credit, LIFO reserve. You're not getting much from that though. You got to understand why this happens, because we're reporting non-LIFO during the period. These are non-LIFO numbers. Then I have at the end of the period an adjusting entry, adjust to LIFO reserve, because I want to report LIFO COGS to take those tax advantages on. All right, so how does this report LIFO COGS? Well, in this example, my LIFO reserve went from 10 to 13, which means I must have had an adjustment of $3, a credit of $3 to make that movement occur. Then my account, in order to put that $3 in there, I would have to credit the LIFO reserve by $3 and debit cost of goods sold $3. Well, what does that do to my overall cost of goods sold? It means whatever cost of goods sold I reported using the non-LIFO amounts is increased by $3 in this example. It increases cost of goods sold, which reduces my net income further, and it increases the LIFO reserve, which, since that's a contra account, reduces my assets more. And that also makes sense, because if you go back to the advantages and disadvantages of FIFO, one of the disadvantages of LIFO was that relatively lower priced inventory balances. So when I move from FIFO, which puts the most current costs on the balance sheet, puts the most current costs, and during times of rising prices, that'll be higher costs into the inventory account. And LIFO, during times of rising prices, reports less dollars in inventory on the balance sheet. So it makes sense that in a switch from FIFO, for example, to LIFO, that we're going to have a lower amount of inventory being reported. And again, going back to those advantages and disadvantages, one of the disadvantages of FIFO is that during times of rising prices, cost of goods sold is lower, creating higher taxes. One of the advantages of LIFO is that during times of rising prices, it increases my cost of goods sold. So under LIFO, you tend to report more cost of goods sold, and that's reflected here because I'm debiting my cost of goods sold. A sort of way to put into a table, just to summarize that information that I just talked about. And of course, you have to say during times of rising inventory costs. So the stuff I'm buying, the stuff I'm making is getting more expensive over time. FIFO and LIFO, which are opposite ends of the spectrum. What happens to cost of goods sold? What happens to ending inventory? During times of rising inventory costs, FIFO records lower cost of goods sold and higher ending inventory. FIFO does the exact opposite. Higher cost of goods sold, lower ending inventory. Now, I mentioned up here that we could record a debit to the LIFO reserve and a credit to cost of goods sold. So when would that happen? It would happen when there is a change in the trend of my inventory costs. So for example, maybe they were rising for a while, but then that difference started to abate a bit. Like it was growing by 5% every month, and now it then shifted and it's only growing by 1% every month. So maybe a partial reversal. Oops. In price trends. That would look something more like this, where if I have a partial reversal in price trends, then maybe it's not that there was 10 and 13, but maybe it went from, instead, same account, LIFO reserve, it started at 13 and then was reduced to 10. Well, in that case, I would need a debit to the LIFO reserve of $3 and credit cost of goods sold by $3, because there was this reversal in the trend of my inventory costs. So let's talk about one more example. I'll just create a problem and we'll end on it, but I will just provide some numbers and we'll talk it through. We got ending inventory balances under FIFO, LIFO. So we got FIFO balances, we got LIFO balances, and I'll just make up some different ones than what I had in the prior one. We got 12/31/21 and 12/31/22. So let's say the FIFO inventory was $150 under FIFO for 12/31/21, and it was $200 at 12/31/22. So this is my ending inventory balance, basically whatever this account says right here. That's what I'm talking about. That's the data I'm pulling. And under LIFO, if I had chosen LIFO, then it's 100 and it is 130 here. So let's assume that cost of goods sold under FIFO was $1,030. And what I'm going to ask you to do is provide the adjustment to LIFO reserve and determine cost of goods sold under Lifo. So in approaching this, remember that if we have a Lifo reserve, if we're adjusting the Lifo reserve, we're reporting our internal record keeping under FIFO. But at the end of the period, we want to produce a financial statement that gives me Lifo numbers for cost of goods sold and ending inventory. So the way I would set that up is I take my FIFO numbers and I realize, oh, wait a minute, this is the non-Lifo. That's what I'm keeping track of in my ledger. This is the Lifo. That's what I'm wanting to report on my balance sheet. On the balance sheet, it's 130, 100. So then from this, I think about, well, what was the adjustment that had to be made? Well, the adjustment arises from the adjustment to the Lifo reserve. So now I have to kind of intuit, what did the Lifo reserve account look like? And I can, based on this information from this table, after I've laid it out a little bit more how I did just in the prior little made up numbers I gave you. If this is my Lifo reserve, then I have to remember, wait, this is a contra account. This contra account reduces this when I report it. I have to reduce 150 by $50 to get it down to 100. I have to reduce 200 by $70 to get it down to 30. That becomes my beginning and ending balances to the Lifo reserve. Then to make the adjustment, I'm not worried about these beginning and ending balances. Those aren't the adjustment. Those are balances that resulted from adjustments. So this piece right here then becomes the missing amount I need, the $20. Well, in order for that $20 to get stuck in there, I have to make a journal entry. I got to put Lifo reserve as a credit for $20. And then I debit cost of goods sold by that amount. So that is my journal entry. This reduces net income. The Lifo reserve credit reduces my assets. And it makes sense with the story that, hey, Lifo reports lower inventory balances and higher cost of goods sold. FIFO does the higher inventory balances, the lower cost of goods sold. And then for the second question, determine cost of goods sold under Lifo. Well, all I did was I've already recorded cost of goods sold of 1,030 prior to this adjustment. So if, we can even put this in here, it doesn't affect what's going on in the transition of my inventory account, my Lifo reserve account, and what I report on the balance sheet for my inventory. But there is a COGS account. It was at a balance of 1,030 until now. I also debited that by 20. So after I make that transition to Lifo accounting, then I will have cost of goods sold under Lifo be $1,050. Great. So that's how you manipulate. That's what you learn from the differences in Lifo reserve. I mean, I did it kind of like to reinforce the narrative, to really give you a visual of what's going on. All the reserve balances is the difference between FIFO at a date and time and FIFO and Lifo at the beginning of the period and FIFO and Lifo at the end of the period. That's what gives me those two balances. And then I can just solve for the adjustment. The adjustment gets journalized. The journal entry has effects to both the inventory, what happened to the overall inventory amount I would report between the two methods, and the overall cost of goods sold I would report between the two methods. And this is a way for an investor to look at companies that one employs FIFO, one employs LIFO. They can get a better idea as to the comparability of those companies. Remember, that's a characteristic of accounting information that allows me to look at two companies at the same point in time and draw a conclusion because they have comparable practices. Well, if they have FIFO and LIFO, their practices aren't comparable. But the guy who reports LIFO likely has a LIFO reserve that I can use to undo the LIFO and figure out what they would report under the alternate method. Great. So that's what I got for you guys today. I'll hang around if there's any questions, but otherwise I hope you guys have a good time. I moved the due date for assignment 9 to tomorrow night at midnight, so you still have time for it. But yeah, if you guys have any questions, of course, always email me, set up a Zoom appointment, and we'll try to get you taken care of. Otherwise, y'all have a fantastic day, and I will see you Thursday.